Is Goodluck India the ultimate transformation story? Welcome to the Q3 FY26 earnings teardown of a company evolving from a commodity steel player into a defense and aerospace powerhouse. Here is the 30-second briefing. We are seeing 9.8% revenue growth driven by value-added products and EBITDA margins climbing to 9.9%. Most importantly, the defense subsidiary has officially commenced production, and shareholders are being rewarded with a 150% interim dividend. Breaking down the Q3 financial scorecard, total income hit 1,038.89 crores, up nearly 10% year-on-year. EBITDA saw an even bigger jump of 22.3% to reach 102.83 crores, as sales volumes for high-margin engineering solutions surged to over 1.2 lakh metric tons. Why did EBITDA jump while PAT contracted slightly? While operating leverage improved EBITDA margins by 101 basis points, the company is paying the price for expansion. Recent heavy CapEx caused depreciation to spike nearly 68% and interest costs to rise over 35%. But remember, cash is king. Cash profit grew 18.2% to 75.77 crores, which is vastly outpacing PAT growth. This is a green signal, proving that core operations are generating massive cash despite heavy paper depreciation. Inside the revenue engine, the high-volume core of CR sheets and pipes makes up 37%. However, the growth is in the specialized segments: 25% from high-margin precision pipes, 23% from engineering structures, and 15% from aerospace-linked forging. Catalyst number 1: defense activation. Goodluck Defense and Aerospace has officially commenced production, with the first order ready for dispatch. They have unlocked an annual capacity for 1.5 lakh artillery shells with a master plan to scale to 4 lakh. Catalyst number 2: infrastructure and auto tailwinds. The company is riding the high-speed rail boom, benefiting from 7 new bullet train corridors. Meanwhile, an export boost is incoming for precision pipes as U.S. tariffs ease. Operations are pushing maximum output, with a capacity utilization of 92%, up from 89% last year. This peak efficiency is perfectly timed to coincide with the addition of the new defense shell capacity. Looking at the valuation, the market cap sits at 3,608.9 crores as of February 2026, with a TTM PE ratio of approximately 21x. The annualized run rate for profit is roughly 168 crores. In the bull versus bear case, we see surging traction in high-margin sectors and easing tariffs against the risks of high interest sensitivity from debt-funded CapEx and raw material volatility. On the red flag checklist, it is a clean quarter with no one-off items. However, stay alert regarding the debt burden. Finance costs have risen over 35%, meaning revenue growth must remain rapid to prevent margin dilution. Despite the heavy CapEx, management is rewarding shareholders with a 150% interim dividend, or 3 rupees per share. This represents about 8% of 9-month profits, signaling strong confidence in near-term cash generation. The final stance is constructive. Goodluck India has weathered the heavy lifting of its CapEx cycle. With the defense subsidiary online and bullet train orders full, the transition to an engineering powerhouse is officially underway. If you found this earnings deep dive helpful, don't forget to like, save, and share this video. Follow and subscribe to ZinvestZ so you see more smart investing insights. Thanks for tuning in.